still moving some folks over into the meeting, so please give us a couple of minutes.
How you doing, Vice Mayor?
Doing fine. Can't complain. Well, actually, I could, but you don't have an extra 3 or 4 hours, so I'll spare you.
That was a nice press conference we all got to. It was very good on the drought issues. Very good.
I agree.
And thank you for your support. Appreciate it.
So Tony, were we able to get everyone over?
Yeah, everybody who's in attendees is over.
Okay.
And I haven't, there's so many names. I think it's quicker for me to call roll than for me to count and try to see if everybody's here.
Okay, well, we'll go ahead and get started. I want to welcome everybody to this joint state session between the San Jose City Council, the Federated City Employees Retirement System Board, and Police and Fire Department Retirement Plan Board. Tony, can we have a roll call, please?
Jimenez? Peralez?
Here.
Cohen?
Here.
Carrasco? Davis?
Here.
Esparza?
Here.
Arenas? Foley?
Here.
Mahan?
Here.
Jones?
Present.
Liccardo? You have a quorum.
Okay, so I'm going to ask each chair to do a roll call for their boards, and we're going to start out with the Federated Retirement Board. And so that would be Spencer. Is he in the meeting?
Julie.
Okay, is it me?
Or Julie?
By Chair Davis, yeah, this is Mr. Pena from the retirement office. It appears that our chair, Spencer Horowitz, is not yet available. So we can ask the vice chair, Julie Jennings, to call roll call if you prefer.
Yes, that
Sure.
works.
Let's see who is here.
This is Tony Tabor, City Clerk. I can call your roll if you'd like. I have your names.
Yeah, that would help. Thank you.
Horowitz?
Sorry, Julie.
That's okay.
It's all right.
Jennings?
Here.
Chandra? Kelleher? Four.
Here.
You have two present.
So, Mr. Vice Chair, and Tony, I think one of the challenges that we have, both of our chairs, Trustee Horowitz is actually at the meeting. But
I'm moving him over. He just has to click accept.
Yes, please. And so is Drew Lanza. They both, I think, came in as public members rather than panelists. And so that's why they're not able to speak.
Okay, so with Horowitz in attendance, you have 3. So I believe that's a quorum for you.
That is correct. Thank you.
Yes, Chair Horowitz is here.
Okay. Thank you, Spencer.
Thank you. Tony, since you're on a roll, why don't you just proceed with the police and fire.
Sure. Lanza, Gardner,
Here.
Ganapati,
Here.
Menon,
Here.
Santos,
Here,
Beto,
Here.
Wilson.
Here.
You have a quorum.
Tony, can I ask for a favor? I think we also have a trustee from Federated, Anurag Chandra, is also joining as a public, if you can.
I've not seen, Anurag?
Yes,
Okay, got it. I was looking for the last name.
yes, thank you. And then Drew was, I think, also as a member, Drew Lanza, but I don't know if he can say
I
his name
don't
or
see
not.
him. I'll
Okay.
keep an eye out in case he comes back.
Appreciate it, thank you.
This is Howard Lee, Trustee Lee.
My
I'm
apologies.
from San Jose Police and Fire.
Thank you. All right, hopefully we have everybody. There probably will be a few more other people join us. So we have a pretty robust discussion that we're going to have today. And Julia and her staff have prepared an extensive slide presentation. And so, and she and her team have created a pretty elaborate and comprehensive story that she's going to be telling. It's going to have some drama, some twists and turns. So get ready. But we want to ask everyone to hold off on your questions until the end of their presentation. Make sure you jot down the slide number if you want to reference a slide number, and also jot down notes as she's presenting, because when you get to my age, you won't remember what you were going to ask at the end of the presentation. So make sure you jot something down. So I am going to hand off the presentation now to Jennifer, our city manager, who's going to kick this off. So Jennifer.
Yes, thank you very much, Vice Mayor Jones. And I really want to thank you for participating in this joint meeting between the City Council and our two retirement boards. I really want to thank the team for their hard work in preparing the materials for today's study session. As you will see, the team has taken a very complex topic and provided materials and information that assist in telling the San Jose pension story and will guide the City Council and retirement boards in their respective understandings of their roles and responsibilities related to the unfunded pension liabilities. Team members include our staff presenters and consultants, along with staff members working behind the scenes. I want to specifically thank City staff Julia Cooper, Jim Shannon, Cheryl Parkman, Nikolai Skarloff, and the debt staff. From our City Attorney's Office, Karen Mirabita and Rosa Songtatari, and our Retirement Services staff, Roberta Pena and Prabhu Palani. The Retirement Stakeholder Solutions Working Group, it's a mouthful, was formed in the fall of 2019, was tasked to address retirement fund resilience and to protect employee and retiree benefits. The group issued their final report in April 2021 with pension obligation bonds as one of the options available to address the city's retirement challenges. City staff has subsequently invested considerable time vetting the issues surrounding the complexity, risks, and rewards in issuing pension obligation bonds, which included retirement boards. I think.
Can you hold on for 1 second, Jennifer?
Yeah.
Can everyone put their mics on mute, please? Thank you.
Yeah, thank you. The City Council participated in a substantive and in-depth 4-hour study session in April 2021 on pension obligation bonds. The retirement boards have also engaged in conversations with their actuary, investment advisors, fiduciary council, and with city staff in August and September. City staff view pension obligation bonds as Julie will say, the last tool in our toolbox to create a meaningful solution to address the unfunded pension liability in our two retirement plans. As the presentation will review shortly, the city has been dealing with the challenge presented by the unfunded actual liability for almost 20 years. Our discussion here today is a continuation of this necessary work. Our joint meeting today is not the first conversation, nor will it be the last. There will be other opportunities along the way to continue to explore ways to address our common interest, and that is how to improve the funded status of our retirement plans and the resiliency of the city in meeting its funding obligations. I will now turn the study session over to Julia Cooper, our Director of Finance, to commence the presentation And we look forward to the conversation and engagement this afternoon. Thank you.
Thank you, Jennifer. So as slide 3 just summarizes the presenters on the city and retirement services. And then on the next slide, our presenters, advisors to the city, along with advisor to the board, Bill Hallmark, the actuary. So our presentation agenda today, we will start off by kind of framing the study session, kind of how we got here and where we need to go, and talk about the roles and responsibilities of both the city and the retirement boards. We do have very distinct roles and responsibilities, and so we'll talk about that. And then Chiron will give a presentation on the analysis of actuarial impacts, and then we'll have our municipal advisor, Urban Futures, talk about the analysis, continuing analysis of a potential City of San Jose pension obligation bond. We'll open it up to public comment, and then we'll have the conversation between the council and the board members with their comments. And then at the end, I'll have a few kind of wrap up. So as we start off the framing of the study session, I do want to thank Jennifer for her opening comments. And as you'll see during the course of the presentation, you know, things are looking better than where they were in April as a result of the unprecedented historical returns for both plans that they experienced in fiscal year 21. But we need to remember as we look through kind of where we've been and where we're headed, the city's UAL in both plans is an issue, and it's an issue that we've worked on to address well now for several decades. We've implemented many, many changes in both retirement plans, all which have helped with the UAL, but at the end of the day, the city still has a big bill to pay. And as Jennifer said, this really is what we believe from a city staff perspective, the last tool we have in the toolbox to make a meaningful impact on the UAL. But it's important to remember that any ultimate decision the city council will have to issue pension obligations will be made on a plan-by-plan basis. So a decision on the federated plan may be different than a decision on the police and fire plan, recognizing the differences and the need for the city to pay its bills. So with that, I'm going to turn it over to Cheryl to start framing the issues and the conversation.
Thank you very much, Julia, and good afternoon to everybody on this study session today. One of the things that we like to talk about, because it gives a lot of context to these issues, is the concept of our retirement plan's maturity. Now, when we talk about maturity, what we mean is how many actives do we have in relationship to our retirees? And why is this important? Well, this is important because when you have a very mature plan, that can increase the volatility of your retirement plans and their investments. So what you have in front of you on this slide is important context for the story that we're going to tell today. So in our federated plan, we actually have more retirees than we do active members. And as you can see, it's about 1.6 retirees to 1 active. A better ratio would be 1 to 1. And why is that a better ratio? Because that means you have as many actives paying into the plan as you have retirees. So why is it an issue if you have more retirees than actives? Well, it can exacerbate any issues in the plan, such as less than expected investment returns. While it can also magnify greater investment returns, it definitely can exacerbate that problem. So that's important for you to know just as we're going through the slide, keeping that in mind. And so this is the federated maturity ratio. And then on our next slide, you can see for the police and fire ratio, it's around the same. So when these, when you have mature plans, and this is one of the measures of these mature plans, these investment returns can be magnified. And as we're talking about investment returns on the next slide, what we can see is our historical federated earnings. Now, the black line that you're going to see on this graph is the expected investment returns from the federated plan. So every year, the boards decide what they think that discount rate or expected rate of return should be. In this last year, they decided it was going to be 6.625%. So the green bars signify the actual returns. And you can see in many of these years, we did not reach that expected rate of return.
1, 2.
So in the years where you do not see us hitting that black line, that means that we've increased our unfunded liability. Now, I have to say in 2021, we had a fantastic year, as Julia mentioned, but we also have these other years where we did not reach what we needed to, which again increases that unfunded liability. And when you go to the next slide, you can see the same trend happening for police and fire. 2021 was a wonderful year for our investments, but we've had, in the past decade, several years where we're not hitting those returns that we were expecting. And that again presents us with the challenge of an ever-increasing unfunded liability in those years where we do not meet that expected return. Part of our challenge is that investment returns change from year to year and can be exacerbated by the maturities of our plans. So as we head into the next slide, what we can see is these historical returns where, judging in the last year to 2021, they're wildly different. So in the fiscal year 2020, we had pretty good returns. We almost met our discount rate, but in some years we didn't. And so I guess what I want you to get from this slide is that there can be anomaly years where we absolutely go above and beyond what our expected rate of return is, but there are many years where maybe we're not going to hit that. And there's a lot of, factors that go into that, but it increases our challenge on a yearly basis because we're always looking backward to see what those returns are. So as we head into the next slide, what you can see is our challenge from the past decade. Our point of this slide is that we want you to understand why we're considering a last tool in the toolbox. Our unfunded liability has remained high for the last decade in terms of our funding ratio. We want to have as many assets as we do liabilities. That's why we're constantly contributing, constantly investing to get to those higher funding ratios. But we still have this challenge that's presented to us where we need to make sure that we have enough of these assets to pay the benefits down the road for our current retirees and our future retirees. And this slide illustrates between the bar graph and the line that we're not there yet. We still have a ways to go until we're hitting our 100% funding ratio. And some of that has to do with the maturity of the plan, the investment returns, a whole sorts of different things, but we still have this challenge that presents itself. So if we go to the next slide, what we can see is this challenge presents itself in dollar amounts. In dollar amounts that the city needs to pay on an annual basis to ensure that we're getting to the right funding ratio. And so we showed this slide back in April. I believe that maybe some of this you'll see in later slides will change slightly, but we still have a significant amount of our budget that goes directly to retirement costs on an annual basis. And this number can increase just depending on each year and each actuarial report. So that the challenge isn't only the funding ratio, the challenge is also the amount of money that we spend on this on an annual basis. And as we go to this last slide for me today, we want to talk about the 2021 investment returns. Incredibly strong investment returns that came out of both retirement plans, and you'll definitely see that in these upcoming slides. They're going to show you the impact that it's going to have on our funding ratio and our contributions, and we're updating it. So what you saw in April, we're now updating it. Something that I think that you're going to hear is that 1 year of investment returns is really good. We need to continue to have those high years and everything be equal and above average before we hit our 100% status.
Check 1 2.
Doing
Check
investment
1 2.
returns alone, right? Everything needs to remain static in order for that to happen. And I think that we know in the world there's a lot of volatility. There's a lot of things that can change. So what are the other things that we can do to ensure that this process happens? And so I'm going to kick it back over to Julia to talk a little bit to you about credit ratings.
Okay, thank you, Cheryl. So as we discussed in the study session back in April, our unfunded pension liability does remain a credit concern with all three of the rating agencies. While we enjoy strong ratings, the rating agencies do look at our unfunded liability as part of the credit analysis. Last year in October in 2020, S&P released a report about the credit ratings among the top 20 cities in the United States. And San Jose was outranked in terms of its liability only by the city of Chicago. And in July 2021, Moody's Investor Services, when they released a report for our GO rating, cited high fixed cost and leverage as one of our city's credit challenges, and stated that a material decrease in the city's unfunded pension and OPEB liabilities would be a factor that could lead to a credit rating upgrade. So on the next slide, this is a graph from that S&P report back in 2000, where you can see graphically where San Jose lined up with the other top large cities in the country. And again, number 2 only to Chicago. So not a situation where we like being near the top ranking on this metric. We prefer to be near the bottom. So on the next slide, as Jennifer pointed out, and as we've told this story, this has been a long effort on the city's part to fix the problem, starting back in 2007 from just a policy perspective, looking at different ways when Mayor Reed formed the Budget Shortfall Advisory Group, different ways that we could reduce our costs to help solve different budgetary means. And as you can see, we took to the voters both Measure B and Measure F in terms of developing a Tier 2 pension plans for both Federated and police and fire, and also worked on reducing our post-employment, the healthcare benefits, and essentially closed that option for Tier 2 employees. So on the next slide, kind of where have we been in the more short term? Mayor Liccardo formed the Retirement Stakeholder Solution Working Group, and they met and issued a final report. The councils had several study sessions to look at POBs, including the most recent one in April. We had a council meeting in May, which directed us to draft the validation documents. And we, as Jennifer pointed out, the city staff has met with both the Federated and police and fire retirement boards. We have this study session today, and then on Tuesday, we'll be bringing to the council to consider the actions related to filing the validation suit, since in order for the city to issue pension obligation bonds, we have to go through a validation process. So with that, I'll turn it over to Jim to talk about why the city is considering issuing POBs.
Great, thank you, Julia. Good afternoon, everyone. So this next slide really kind of paints the picture of sort of a practical implications of where we've been. So over the last 20 years, we can see how retirement costs have impacted the general fund, which is some of the most visible impacts of retirement costs. And so the blue line below represents the retirement costs in the general fund, and the yellow line represents the retirement costs as a percentage of the adopted budget in the general fund. And we can see why we've had this sort of 20-year sort of grappling with pension costs. And especially, linking back the timeline above, you can see there from 08, 09 through 11, 12, where we really had sort of really an existential problem with the city's budget in terms of pension costs, and is indicative of the reason why we had to take some of those drastic measures. I think, one of the good takeaways from that is we're in a stable position. You can see that yellow line has essentially flattened since a lot of the pension reform efforts were implemented. So even though retirement costs have grown, you can see in the blue line, as a percentage of the general fund, it's relatively stable, which means it doesn't crowd out services or other programs the city may provide, even though that retirement costs are going because revenues are generally growing as well there. But what that does still tell us is that we still have quite a bit of a challenge ahead. So going from 6% of your general fund budget to 22%, that's a lot of capacity that's taken up that could otherwise have been used for services, and has been sort of a key factor of our, why we're some of the leanest city in America, because we're sort of challenged with some of these costs. And so looking on the next slide, why are we considering the POBs from a city's perspective? So number one, we really want to make sure that we can improve the city's funding levels of the retirement plan. The city is always going to pay its pension bill. And so, we'll make sure that we make our payments, but we want to make sure that those plans are in the best funded position that's practically possible. And so POBs is a potential tool to use that. As a important side benefit would be the reduction in budgetary costs related to supporting the UAL. So as that UAL goes down, that's more resources that could be spent on other city services. And it's really sort of managing, the organization's long-term financial sustainability and success as an organization to serve our community. We said this a couple of times, it is sort of the last tool in our toolbox. We did a lot of really heavy lifting 10 years ago for pension reform. And so, so now what else is really left? And being able to issue POBs is probably one of those last options to make a meaningful difference outside getting 25% returns on our investment every year. I suppose that would be even better if that was possible. And so what POBs do is they allow us to borrow funds to pay down the UAL, be part of a long-term strategy and comprehensive approach that we would be talking about with both the city council and the boards. We would not consider this as part of our normal costs or as a pure strategy just to balance the general fund. It's really about a holistic picture, about trying to have the funds be in a better funded status while also effectively managing the city's budgetary resources. And we probably won't always get as great of returns as we did last year. And so we want to sort of think ahead for the challenges that may still be out there. Julia.
Thank you, Jim. So how can POBs save the city money? So they're really only issued when the borrowing costs are expected to be lower than the long-term assumed rate. And we can replace the UAL, which has a higher cost obligation that's owed to the pension plans, with a lower cost debt owed to bondholders. So that's where we get the savings, because the UAL is right now amortized at that 6 5/8 for both plans. Then they have been trending that number down lower. But in the current market, we could lock in a pension obligation rate at somewhere between 2.75 and 3.5%. So while the actual returns maybe vary, the city staff is comfortable given the current market conditions, if we were able to issue POBs today, that the boards would be able to achieve long-term results of at least 3.5%. And it's important to always remember that a failure to achieve returns equal to the discount rate is a problem whether POBs are issued or not. So then on the next slide, kind of the economics of a POB. So the UAL is what's determined on the discount rate. So that's how it's calculated. And the discount rate is the expected rate of return. So we use the value of the cost of the future pension payments to today's dollars to kind of amortize that UAL. So it's comprised, and Bill will get into a lot of detail about this, but the UAL is comprised of many amortization bases. So just think of it as a lot of loans stacked on top of each other, and they're all discounted or calculated based on that same rate of return, which is the 6 5/8. So, but the bond market offers the ability for the city to serialize those bonds, and therefore that we pay interest rates based on each maturity of the bonds. So the shorter bonds would pay a lower interest rate than the longer bonds. And then when all averaged together, the overall interest rates in today's market, as I said earlier, average between 2 3/4 and 3.5%. So as what you can see on the next slide is a kind of a graphic illustration of that. So the discount rate, that green line, at the 6 5/8, that's the amortization of the UAL. So, and when you issue a POB, you say, okay, I want to take a portion of that UAL and fix it on a city perspective by issuing POBs. And POBs are taxable municipal bonds that are priced off of the US Treasury yield. So this is an example of a recent POB that was issued by Huntington Beach. And you can see how their interest rates were. The dotted blue line was the treasury yield on that particular day that those bonds were sold. And then you can see the interest rate that was for each of the bonds in the bond issuance and what those interest rates were. So you can see for a 1-year maturity, it was as low as 22 basis points. And the final maturity, they issued 23-year maturity bonds. It was 3.38%. And so that's kind of the difference between how the amortization of the UAL happens to determine how much is owed, and then how the city would reduce its overall costs by issuing POBs. So on the next slide, we look at the potential positive impacts for both the city and the retirement plans. Obviously, we would reduce the annual payments to the plan associated with the UAL, which would be replaced obviously by the city's portion that we would pay debt service on the POBs. We believe it would help mitigate future volatility related to the annual UAL payments, since each year the UAL is determined based on the report that the actuary puts together, and that discount rate can change. The bonds are fixed rate bonds, so we lock in that payment for that period of time that they're amortized. Then, as there's budgetary savings that potentially comes from that, we could accelerate the amortization of the unfunded liability by using some of those savings to pre-fund the UAL and make those payments. And there would also ease current budgetary pressures that the city is experiencing. The positive impacts for the retirement plans are obviously an infusion of cash for new investments. It would increase the funding levels for the plans, and then obviously reduce the reliance on the city for contributions in order to fund the payments due to retirees. It's important to remember there's no payment obligation for the POBs from the retirement plans. That's 100% the city's responsibility. Then on the next slide, as we're trying to talk through in this presentation in terms of, who's responsible for what. The city is always responsible for funding the pension liabilities. We get a bill and we pay it. That's our responsibilities. We're also responsible for determining the pension funding strategy and looking to the council to look at developing some more robust policies around that. We make our annual contributions for both the normal costs and the actuarially determined amortization of the UAL. We also have an obligation to our residents, employees, and the retirees of the city of San Jose. On the other side, the pension board's responsibilities are to obviously invest those assets, determine the investment strategy, make the determination on their actuarial policies that are used to determine those payments that are due from the city. And they have the obligation to the past and future retirees of the city of San Jose. So when we look at this, we say, we really have a chicken and an egg here. And so the city really doesn't want to borrow funds until they know how those funds will be credited towards the UAL and how they'll be invested by the plans. And the retirement boards have expressed an interest in knowing how much the city will borrow in order to determine those actuarial policies and investment strategies. So as we work through this, it's important for us to kind of get comfortable. So how do we engage in this conversation so we both sides have an understanding to make a decision to move forward in an educated manner? So on the next slide, what are some of the solutions that we have to mitigate some of these uncertainties? One is the development or confirmation of existing policies. The city staff will be working on a pension funding policy to bring forward to the council in the early part of calendar year 2022, which we think will help guide the decision-making process. The retirement boards have their investment and amortization policies. We're also looking at exploring the opportunity for a memorandum of understanding between the city and the board. So we kind of know how are we going to act moving forward relative to funding the UAL. The current, as we've mentioned, our conversation today is really not the beginning, is the beginning, not the end of this dialogue. And then we need to have a reoccurring dialogue as the issuance of bonds could occur over a matter of years as the city's pension liabilities are really never extinguished. So on the next slide, some of the things that the city would look at in a pension funding policy would be, what are the potential funding sources, whether it be bonds, budgetary savings, one-time money? How would we structure the guidelines if in issuing pension obligation bonds? What kind of minimum thresholds would we want to see in doing that? What kind of spread would we want to see between our borrowing cost and then the assumed discount rate that the plans had in place at the time? And that we would also have no extension of the term. So if the UAL is amortized over 15 years, we wouldn't be issuing bonds for 30 years. So that would be an important policy decision to make. So then finally, we say, what is kind of the alignment of the interests? So we've talked about the city has determined we need to determine our funding strategy and our policy, and we have an obligation to make these annual contributions to the plans. And the retirement boards, obviously, their interest is to invest those proceeds and meet their benchmarks, determine an appropriate asset allocation, and set their own policies. But at the end of the day, all three of us have the goal to have an improved funded status of both plans. So with that, I'm going to turn it over to Roberto.
Thank you, Julia. Much appreciated. I think city staff have done a fantastic job. My responsibility here this afternoon, and welcome everyone to our meeting, is to sort of kind of give you a picture of, generally speaking, how our both plans are doing today. I can tell you that Cheryl Parkman did an outstanding job providing you some background and past history on how the plans got to where we are today. So if we can go to the next slide. So again, I'll be speaking about the difference between the two plans today. Prabhu will be speaking about investment strategy. And later on, Bill Hormar will be addressing the actuary for the boards. He will be addressing amortization strategies and existing policies that both plans have in existence right now. If we can go to the next slide, please. So I wanted to share with you, you have heard repeatedly from staff that the fiscal year ending June 30th, 2021 was an outstanding investment year. And so these numbers reflect where both plans are today. So a couple of caveats with these numbers. Number one, I want to call your attention to the bottom part, the funding ratio. On the police and fire, the market funding ratio is 87.2, and the actuarial funding ratio is 77.5. And I will explain the difference between the two in a second. For Federated, those numbers are 63.7% for market and 55.5% for actuarial. So first point I'd like to make is the contributions that are determined by the actuary and that the city pays on the annual basis to the plans are based on the actuarial funded ratio. It is not based on the market. Again, it is based on the actuarial number. Now, the goal with presenting these numbers to you this afternoon is they are a reflection, and these are preliminary numbers, a reflection of the most recent returns for the year ending June 30th, 2021. The second caveat that I want to mention is Chiron is right now undergoing the actuarial evaluation for both plans. So we do expect the numbers to be impacted, not the market side of the assets, but the actuarial side. And the reason for that is as they go to the process, they're going to be looking to the actual results. So there always are some differences on actual experiences vis-a-vis what the assumptions are. But the number two, on the second one, you saw in a prior slide that the boards have been determining the discount rate on the annual basis, and it is sort of like in a downward slope. It's been slowly but surely continue going down. There might be years that they don't move it, and then other years it may go down 12.5 basis points. So if the boards elect to decrease the discount rate one more time, that will have an impact on the actuarial side. That will increase the accrued liability. And by increasing the accrued liability, that will decrease everything else equal. It will decrease the funded ratio. So I just wanted to kind of give you, again, a general understanding as to where are the two plans today and the basic difference between the market and the actuarial value. And most of you that have been at with the city council for a few years know that when I go, one of my slides include the smooth process, which is a process that actually what it does is it takes investment returns spread over 5 years. And so the difference between the market value and the actuarial value is that the market value is the actual value of the assets as of June 30th. The actuarial value, how we get to that is we actually take 20% of each one of the last 5 years returns and recognize them. So for June 30th, on an actual basis, the returns that we're recognizing are not the full returns for June 30th on a market basis, but 20% for 2017, 20% for 2018, 20% from 2019, and so on and so forth. That's where the difference is. It just so happened that today, the actuarial value is lagging the market, but over time, there could be a situation where the market will be lagging the actuarial value. So again, bottom line is contributions are made to the plans on actuarial basis. These are the preliminary numbers today, and the plans actuary is undergoing a actuarial report right now, and we will have updated numbers later this year for you. If we go to the next slide, what I wanted to share here, we have two slides. One is for Federated and one is for police and fire. And the goal here is actually twofold. The first one and foremost is to sort of kind of give you a sense and what are the expected contributions from the city for the next 20 years or so. And you see for Federated, the contributions for the fiscal year ending 2022, which are really based on the evaluation for last year, for June 30th, 2020, are $206 million. And again, I want to make it clear, these are just pension contributions. This does not include the OPEB. And the line that you see on top, just so that you get a sense of how impactful an outstanding year on investment returns can be, is prior to the 2021 investment return year, for the 2020 valuation, the line that you see on top were the expected contribution amounts based on the 2020 valuation, assuming that 2021, the plans were going to return the discount rate, which at the time was 6 5/8. So again, in 2020, if the return, the actual return for the plan would have been 6 5/8, then and it's the same 6 5/8 for the next 20 years, that line will be determining the contributions for Federated, where in 2037 will be $277 million instead of the 218.5 now that we have the preliminary numbers for 20 and 21. But again, a big caveat here, you're gonna hear me say this many times today, you're gonna hear the actuary say the same. These roll forward numbers assume that the plans meet all their assumptions. Obviously, the most critical assumption here is that they're going to be making the assumed rate of return going forward, along with all the other assumptions that we have in terms of retirement and longevity for the members and everything else. And I think that you earlier heard Cheryl telling you that one thing that we know for sure is that we know going forward with all the volatility, we know we're not going to be actually earning the actual rate of return. We may do earn that over time, but it doesn't mean that it's the same return every year. And so if you can go to the next slide, I won't repeat everything I explained, but it's the same concept. It assumes that based on the 2020 valuation, the line on top is the one that we were expecting those contributions to be for the police and fire plan, because we were assuming that in 2021, the plan was going to be earning 6 5/8. As we know, the plan earned more than that. And given the preliminary numbers based on the new expected actuarial funding ratio, the new expected contributions are the one, the combination of the, I think, purple and yellow. So those are lower numbers going forward. Again, the caveat here is that these roll forward numbers assume that the plans will be meeting all the assumptions going forward, which we know for a fact that won't be the case. Well, for purposes of discussion, because we don't know how the future is going to behave, we just assume that all the assumptions are going to be met. Later on, when Bill Hallmark from Chiron speaks to you, he does have a model that he used as a stress test where he can actually input different numbers instead of the assumptions or the assumed return. He can actually, in his model, he can actually use different numbers and show you how a better returns or worse returns will impact these contributions going forward. So that concludes my portion of explaining to you the differences between the two plans and where are the two plans today. Next is the plan Chief Investment Officer, Prabhu Palani, to speak to you about our investment asset allocations. Prabhu?
Thank you, Roberto. Good afternoon, everyone. I was actually asked to talk about a potential investment strategy for any proceeds that we receive from POB issuance. And unfortunately, it's a little premature to talk about that because there are a lot of unknowns. We don't know the size of a POB issuance. We don't know the timing of a POB issuance. We don't know the structure of a POB issuance. But I thought I can lead off by showing you this chart, which actually has our current asset allocation for both plans. And typically, in the past, we've tended to move in incremental fashion. So hopefully this gives you some clue as to how we will think about investing any additional proceeds that we receive in addition to the $8 billion plus that we manage today, which is both pension plans as well as the healthcare trusts. Now, of course, all of this assumes that things are stable and somewhat, if there isn't a lot of volatility. As you all know, in March of last year, there was considerable volatility and we did make some big changes to the plan. And that could always happen, right? And so typically the process that we follow when we decide to deploy any proceeds is, we get capital market assumptions from our investment consultants every year. That typically happens at the beginning of the year. And then we look at market conditions and then we decide how to invest those proceeds. We come up with a discount rate. We come out with an asset allocation. This is extensively discussed at our investment committee meetings and then by the boards, and then we decide what to do with the proceeds. So it's a little difficult for us to say, next year, if there's a POB issuance, how we'll actually invest those proceeds. But I think it's suffice to say now we have $8 billion. If the POB issuance among both plans is say $500 million, so we'll then decide instead of $8 billion, we'll have $8.5 billion. And if it's $1 billion in issuance, instead of $8 billion, we'll have $9 billion to invest. And I'd like to put this in some context. So every year the city actually funds our pension outlay for the year, and that's about $400 million. So we do get about $400 million approximately from the city every year. And so we are able to absorb that without too much difficulty. And I'd also like to point out that in the last quarter, just in that quarter alone, both plans actually added something like $400 million in investment returns. And again, that's easily absorbed, and we put that in the grand scheme of things into the whole pot, and then we decide how an asset allocation has to work. Now, a lot depends on, on timing in the market, as you all know. We've had a fantastic year this year. And as you can see from this chart, the important thing here is at the bottom, you see the average annual expected return for 10 years. For the Federated plan, it was 6.3%. Police and fire, it was 5.9. And a 20-year return was 7.1 and 6.8. Now, these numbers were at the beginning of the year, beginning of this calendar year. And since then, the markets have continued to be strong, barring the last couple of weeks, of course. And so what that means is that our average annual expected returns have actually gone down even more, simply because we've had such a good year. Now, if we continue to have a good year this year, you can expect that those returns, expected returns, are going to be even lower next year when we consider our asset allocation, right? And it also means that markets are going to be very, very expensive next year. So we have to take all of that into consideration when we come up with our asset allocation. Again, I'm showing you our current asset allocation as a guide. because we always start with our current asset allocation, and it's usually we use an incremental approach. But I'm going to give you some numbers just to put things in context, just to show you how expensive the stock markets are. We did, of course, get a windfall last year because the markets suddenly became very cheap in March and April of 2020, and we took advantage of that. But since then, the markets have actually been on a tear, as you all know. So I'll give you two measures here. One is a simple PE ratio, and the other is a cyclically adjusted PE ratio. If you look at a simple PE ratio, and I've looked at data going back 150 years, our current PE ratio for the S&P 500, which I use as a proxy for the stock market, on August 1st, the PE ratio of the S&P 500 was 34.71. Now let's put this in context, right? During the Great Depression, I'm talking September 1929, that PE ratio was 20.17. Its all-time high was March 1st, 2000, before the tech bubble burst, and the PE ratio then was 28.31. Today, it's around 34, right? Now, let's look at the cyclically adjusted PE ratio, which is a little bit more realistic because it's inflation adjusted and it's a longer term number. On August 1st of this year, that number was 38.44. Its all-time high was on March 1st of 2000, which was 43.22. So we're not too far from there. And again, if you go back to the Great Depression, September 1st, 1929, that number was 32.56. So markets are very, very pricey. Again, if you look at the last 150 years, if you look at a 30-year time period in those last 150 years, if you had invested the proceeds, any proceeds, entirely in the equity market, just to give you an example, and I'm not suggesting that we do that, but if you had done that over a 30-year time period, you would have never lost money, right? But over a 20-year time period, there was one time period in the last 150 years when you would have actually lost money. And that was if you had invested around October of 1929 in the market. We call that as Black Tuesday, which was October 29th, and Black Monday, which was October 28th of 1929. If you had invested money at that time, you fast forward to October of 1944, and even without adjusting for inflation, you would have actually lost money, right? That's over a 15-year time period, but there's only one data point that I could find in the last 150 years. But if you look at a 10-year time period, there have been multiple time periods in the last 150 years that beginning on the start and end day, you'd have actually lost money. The last such instance was in 2010. So if you had actually invested money in 2000, and if you'd taken that money out in 2010, even without adjusting for inflation, there's about 15 or 20 month time period when you'd have actually lost money. Now, I'm not suggesting that this is, we are in the Great Depression or we're anything close to that. On the contrary, the Fed has actually started removing it's going to stop, started tapering, which means that there is a lot of strength in the economy. But I just wanted to share those numbers just to show that we are in an expensive market, and our boards will take that into account and other information provided by our investment consultant. When we have that big pot of money, the 8 billion that we currently manage, any potential POB proceeds that we have, that we get, will be added to that 8 billion. And we look at that entire pot of money and then decide how we should actually invest that entire pot of money, whether that's $8.5 billion or $9 billion. So with that, I'm actually going to stop my formal comments. I will be happy to take questions. I'm assuming that's going to be at the end. So thank you very much.
Thank you, Prabhu. The questions will be at the end. So thank you.
Good afternoon, everyone. I'm Bill Hallmark. I'm the actuary for both boards. And you can move forward, I think, 2 slides. I wanted to provide an update on what we're looking at in terms of the projections since we've had the exceptional investment returns, but also talk about the sensitivity of those projections to future events, and then how we may react to different conditions in the future. So right now, as Roberto showed, the police and fire plan is 87% funded. It's on track to be 100% funded in 8 years by 2029. When I say on track, though, that means that all of our future assumptions are met. The current contribution policy stays in place, all the assumptions stay in place, and we actually earn 6 5/8% each year. So there's variability around that, but our baseline projection would have the police and fire plan fully funded by 2029. Federated is only 64% funded. It is, given our policies and contribution schedule, on track to be 100% funded by 2039, 10 years later. Again, we'd have to get 6 5/8% each and every year until 2039 and keep the same set of assumptions and have all of those assumptions be met. The city's contributions and the funded status of the plans is most sensitive to investment returns. It fluctuates with the other factors as well, but it's highly sensitive to investment returns. Then the board decisions that really go through the actuarial side. Prabhu talked about the investment piece, which is related to some of our decisions. But our key decisions that affect the city are the discount rate and the amortization methods. The amortization methods are how we pay off an unfunded liability. And those decisions reflect changing market conditions, the asset allocation that Prabhu and his team develop along with the boards, the funded position of the plans, and the perceived tolerance for risk. So all of those things make it difficult to say exactly what we're going to do in the future. Looking at each of the plans one by one, here are updated baseline projections for police and fire. On the left side, the red bars represent the unfunded liability, which right now is about 700 million, and we're 87% funded. You can see we're projected to have that unfunded liability decline steadily until 2029 when we start developing a surplus. So negative bars are actually a surplus if all of our assumptions are met. On the right-hand side, we show the projected city contributions, and they're split into two pieces. The purple bars are the normal cost, which is the cost for the benefits attributed to that year of service. So it's what your current actives are earning each year as benefits. And the gold bars are the payments to pay down the unfunded liability. And so for 2022, the total of those two was 217 million. Because of the investment returns, and we smooth those in over 5 years, you see a sharp decline projected over the next 5 years before it levels off and then declines further as we become fully funded. The purple bars, that normal cost, is also the city's minimum contribution. So regardless of what surplus we develop, the city will always have to pay that normal cost contribution under the municipal code. Now, we know that there could be a wide variety of outcomes in investment returns. So if you go to the next slide, we've got these same projections under some illustrative scenarios. These scenarios aren't meant to be realistic, but to give you an idea of how sensitive these projections are to different investment returns. The baseline line there in blue is what was shown on the prior chart, both for the unfunded liability on the left and the contributions on the right. The outside lighter lines show a 1-year positive shock and a 1-year negative shock. A 1-year positive shock, we're saying, is a 30% investment return for 1 year, followed by 6 5/8% returns. The negative shock is a minus 15% return for 1 year, followed by 6 5/8. And so just looking at the unfunded liability, you could see that that range could have our unfunded liability go right back up to about 1.6 billion with the minus 15% returns, or turn into a surplus of 500 million with another 30% return year. Now, based on Makita's capital market assumptions, we'd expect roughly 90% of returns to fall between those two. So you could have even more extreme returns, but those would be pretty extreme returns for 1 year. The 5-year moderate negative and 5-year moderate positive scenarios are a 2% return each year for 5 years, or a 10% return each year for 5 years. And we just picked those based on Makita's capital market assumptions. Roughly half of the returns we would expect to fall between those two numbers over a 5-year period. And you can see those have pretty dramatic effects as well, both on the unfunded liability or surplus and on city contributions. If you look at the chart on city contributions, you can see that in the 5-year moderate positive and in the shock, it drops all the way down to the normal cost rate, which is just above $50 million a year in contributions. But on the negative side, it could bounce back up all the way to $250 million a year in contributions. So there is a wide range and a lot of sensitivity in the police and fire plan based on these investment returns. We go to the next slide, we can look at Federated. It's a different story. It's currently 64% funded. And if all of our assumptions are met, we also project a pretty steady improvement in the funding of Federated. But after 15 years, we project only reaching 94% funded. The contributions on the right also are much more stable. There's no decline projected. They bounce around a little bit as we recognize the investment returns and as we increase payments on the unfunded liability. But they're roughly about $200 million a year over the next 15 years, and a long ways from the minimum contribution of the purple bar or normal cost. We go to the next slide, we can look at those same scenarios. And you can see even in the good scenarios, we don't get to full funding until very late in the picture. On the city contribution side, the range of city contributions is much narrower. We're not getting down to the 50 million. We could go above 250 million, but we're starting at a $200 million roughly baseline projection. So there's less variability on Federated side. Why is that? Well, there are less assets. Federated has about 2.9 billion in assets, whereas police and fire has about 4.7 billion in assets. And so if you have less assets, that's less sensitivity to those investment returns, both positive and negative. These projections also assume that the boards don't make any changes to any of their policies. And I would say certainly if we develop suddenly a $500 million surplus for police and fire, I think we'd be having a lot of discussions at the board about changes in policies. So you do need to take that into account when you're looking at these projections. Let's move to the next slide. I wanted to just give you a flavor of how the discount rate discussions go and how a POB might impact it. It doesn't have a direct impact on the discount rate. we set the discount rate with a focus on the current capital market assumptions and the asset allocation. And those capital market assumptions change when market conditions change. And Prabhu talked about a lot of this. The market interest rates change, the price earnings ratios change, and that changes our expectations going forward. For 2021, the capital market assumptions are lower than they were for 2020. And as Prabhu indicated, we might even expect for 2022 for those to continue going down depending on what the market does in the interim. The board sets the asset allocation, which is the other piece that goes in there. And that's going to be based, as Prabhu had indicated, on the market conditions. They also look at the level of risk that they deem acceptable and the funded position of the plan. I think one of the key pieces is if the plan becomes fully funded, we would certainly be considering removing some risk and trying to shore up the position of the plans so that we don't develop a large unfunded liability going forward after having achieved that fully funded position. But that's not just a trivial change to make. So there'd be a lot of board discussion, and we don't know exactly how the board would come out on that process. Go to the next slide. I wanted to just emphasize how much market conditions have affected the history here, because we've talked about how discount rates have come down. And I think Cheryl had a slide going back even further than this. But this slide's looking at the Federated system discount rates going back to 1993. And in 1993, they used 8.25%, which I think they just dropped from 8.5%. But at that time, the yield on a 10-year treasury was about 6%. So in order to get the 8.25% return, the plan just had to exceed the yield on a 10-year treasury bill by 2.25%. And the asset allocation at that time was about 50% fixed income. And it was very simple. There was an allocation to public equities and to some real estate. If you fast forward, now the yield on the 10-year treasury is about 1.5%. Last year, it had dropped all the way down to 0.7%. But at 1.5%, if we were taking that same level of risk, that expected risk premium being the difference between what we expect to return and what we could get in a risk-free bond, we'd be looking at about a 3.75 to 4% discount rate. But instead, over time, what the boards have done is some sort of blend of reducing the discount rate and changing the asset allocation. And changing the asset allocation so that we can get a larger expected risk premium above the yield on the 10-year treasury. Now that bounces around every year, so you can't look at it precisely every year, but you can see the general trends, and those general trends in the market make a huge difference, both in the asset allocation and what the expected return or discount rate will be. Going forward, the key questions are what's going to happen to interest rates, what's going to happen to price earnings ratios, and is there a desire to reduce that expected risk premium, or are we comfortable with it in the 4 to 5% range? So there's a mix there of what happens with market conditions and what happens in terms of the board's concerns about the expected risk premium that we'll see going forward. Next slide. The amortization policies the boards have set up are really a mechanism to structure payments to pay off the unfunded liability. And that structure is designed to help manage the stability and predictability of city contributions from year to year. We really don't want to have a sudden increase in the city contributions that hit your budget all in one year. We also tend to not like to have the contributions drop off a cliff and suddenly decrease because we know if the markets reverse themselves, it would be hard to restore the level of contribution we had before. So the boards periodically act on the amortization policy and make some changes. The Police and Fire Board a few years ago was looking at an upcoming cliff and some volatility in the pattern of contributions and made some changes to stabilize that and create that nice smooth downward pattern that we're seeing now. The other thing that we're looking at is we want to make sure that whatever we set up is going to pay off the unfunded liability in a reasonable period of time. Now, there's some fluctuation on judgment about what a reasonable period is. In general, actuaries over the last decade have kind of come to settle on a 15 to 20 year period. And that's really what's driven the current amortization schedules, where the Police and Fire is using a 15-year amortization and Federated is using a 20-year amortization. And so if there was a POB deposit right now and the boards didn't make any changes, we would create a credit for the amount of the POB deposit that was over 15 years for Police and Fire and over 20 years for Federated. Now, I can't speak for the boards, but I would say that if the city issues a POB, we would likely recommend that the board match the period of the amortization credit that we provide against city contributions to the term of the POB the city set up. And that's mainly going back to that desire to manage the stability of city contributions. If you create a mismatch in those periods, you create the potential for some sudden increases or sudden decreases in the city's contribution. So within reason, I think we would likely match the amortization periods. There are other adjustments we might make to the amortization, but given the difference in interest rates, in all likelihood, that amortization credit would be sufficient to match or exceed the payments you're making on the bond, just given the difference in interest rates. So I think that's all I wanted to convey at this point, and I'll take questions at the end.
Thank you. So this is Lindsay Fox with Urban Futures, serving as the city's municipal advisor on pension funding solutions. So this afternoon, we were asked to provide some illustrative examples of a pension obligation bond issuance. Next slide, please. And we recognize that POBs have not been authorized yet, and no parameters, including the size, maturity, or timing of potential POBs have been decided on yet. So there's still a lot to consider, and as the discussions move forward, we will certainly be running more scenarios requested by city staff and council members. But for today, we wanted to provide some illustrative examples of a POB issuance and highlight a few of the considerations before zeroing in on a size and structure. Ultimately, the size and the structure for pension obligation bonds will be informed by the stated goals for issuance of POBs, as Julia and Jim reviewed earlier. But as a recap, one of the primary goals of the city is to ensure the long-term sustainability of the retirement systems by improving funding ratios of the plans. So the city and the retirement plans can jointly discuss a desired target funding ratio, which would inform the size of the POBs. But setting that aside for now and to move discussions forward, And dovetailing off of Bill's presentation, we wanted to focus in on the impact of the retirement plans amortization policies on the UAL payments that the city is responsible for making. And that addresses the city's goal to reduce the annual burden of UAL payments that potentially crowd out services and create budget stability. And as Bill just mentioned, there is an aligned interest to ensure that the terms of the POBs match the term over which the credit received for the POB deposit is amortized. And doing this allows the city to fully benefit from the credit and also reassures the retirement plans that the city isn't kicking the can down the road by extending debt service on the POBs while taking all of the savings up front. Next slide, please. So in order to provide a reference point, this slide recaps the midpoint POB scenario that was presented to council on the April study session. This assumed a total $1.4 billion issuance, $960 million for Federated, and about $520 million for police and fire. This is also based on the 2020 actuarial report. We will update once the 2021 actual report is released, but it doesn't change the concepts that we're presenting here. We wanted to provide a comparison of what you've seen previously. So our prior scenarios assumed a base election targeting strategy, essentially selecting one of the bases to pay off with the POB proceeds. And this is a standard approach for many CalPERS member agencies. Typically, the POB term matches the term of the bases that are selected to be paid off. Next slide, please. So we recognize that the base election strategy is a departure from the retirement board's current amortization policies, but we did update the $1.4 billion POB scenario, again, to keep things consistent with two potential structures. The first matches the POB term final maturity to the current 15 and 20-year amortization policies of the plans that Bill just described. And the second scenario considers matching the amortization of the credit to a shorter, potentially more optimal POB term. Next slide, please. So before I turn it over to my colleague Julio, who will walk through the updated POB scenarios, I'll just go ahead and tee things up for him by providing some background on the amortization policies. Again, dovetailing off of what Bill just presented. So here on this slide, we're showing on the left potential level debt POB issuance and the current amortization policy for Federated 20-year with a 2.75% annual escalation. So on the left graph, you'll see that any savings is really pushed to the back end with a level debt POB scenario. But the amortization policy, the 20-year with a 2.75% annual escalation, matches the Federated plan's UAL payment schedules, which also escalate over about a 19 or 20-year term. So in this case, it may make sense to issue a pension obligation bond for Federated with a 19 or 20-year term. Next slide, please. So for police and fire, you see the same structure of escalating credit. So savings are on the back end. However, the amortization, the 15-year with a 2.25% annual escalation is longer than the UAL payments, which amortize faster, you see on the right-hand side. So in this case, it may make sense to structure POBs with a shorter term, a 9 or 10-year term, and have the credit amortization match the shorter POB term. So again, to walk through the scenarios in more detail, I'll turn it over to my colleague Julio.
Thank you, Wingsy. So we've now gone through 55 slides, and I will try to make this as brief as possible. And there are a lot of charts, but I'll get to this part. It's actually the egg. We're going for the egg first, the amortization policy, and then the chicken. The big decisions will come later. But you'll see how it's so integral in trying to make these decisions make sense. So long story short, we agree with the actuary's recommendation, and I'll hopefully illustrate why we think it gets you to a better solution or can get you to the solution easier if you are able to match the terms. So right now, Wingsy was talking about having a 15 and a 20-year amortization credit. So think of it this way: you issue a POB And what Bill says is you get a credit over a number of years, a loan and a credit. What happens though is the shape of the cash flows will change over time. So they're static. At the long story short, you have a static credit of 15 and 20 years, which looks okay now, but if you can imagine in 5 years you issue something, you'll have a credit. See this gray, when we were talking about these unused credits, that's essentially one of the problems with having a static 15 and 20-year amount, that you'd be leaving money on the table or not being able to get take advantage of that. The second component, as Wingsy said, is you see how it starts to escalate down, but it's going up. You're not also getting the full advantage of that. So this idea that you either leave credits on there or you can't match the cash flows to the solution you want is really what we are trying to illustrate. So it works. The current policy works right now, but our notion was looking forward, where you look at cash flows. Next slide, please. It's working okay, but you see underneath in this slide, you see these little credits that you're not taking advantage of. And down the line, you will probably end up with a more pronounced impact that you're leaving credits on the table, or you can't manage the cash flows in the same manner. So Bill mentioned a couple things, this concept of mismatch, which we hope will illustrate the next time, and also this idea of predictability and manageability. So we believe in his recommendation is allows you to resolve both of these issues, both to match the terms, which is the ideal concept, and secondly, predictability and manageability of cash flows, which is our objective. So if you go to the next slide, these are cash flows. You see some of the savings. So if some of you like a graph, this is the chart. But the next slide, we're going to talk about what happens if you actually match the terms. And you see here, what we did is we gave you a 19-year and a 9-year POB. So as opposed to 20 and 15, we shortened it. But you see what happens is that little gray line that was there before, that unused credit, right? This is like a credit anyone has at Macy's. You return it, can't use it. It's that same notion. And it allows us greater flexibility, once again, manageability and predictability. That is why we agree with the actuary's recommendation. It is very similar to what we did now that you're able to match the terms, and we think will get you to a better objective. Next slide, please. And you'll see the cash flows at the end of the day. There's no leftover monies, and we'll be better able to shape things. So next slide. If someone likes to see actually what the savings are, they come out here, but you can see the cash flow differences. You're always having level debt service, but the credits are somewhat different. And what we hope to be able to do is shape our overall cash flows combined. You can compare this is here for illustration if someone sees the numbers, but long story short, it's the egg. We want to go towards the amortization policy. 2, we'd like to match it to have more predictable and manageable cash flows, and more importantly, eliminate that potential mismatch either now or down the road. From there, I'll hand it over to Julia.
Okay. Thank you, Julio, and thanks all of our presenters today. So with that, Vice Mayor and the council and the boards, this concludes our part of our presentation. I do have some final wrap-up slides at the end of the discussion, so I'll turn it over to you, Vice Mayor, to facilitate the public comment and the board and council discussion.
Thank you, Julia, and thank you to all the presenters. Before we go to the public comments, I have a quick question. Is 80% passing, or are we going to grade this on a curve? So anyway, let's go to the public comments. And our first public speaker is Tessa. Go ahead, Tessa.
Give me just a second to unmute her. There you go.
Okay, thank you very much. This is very interesting, but of course the projections are of a very stable future, and we have a very unstable future, and we're supposed to be Homo sapiens. Homo sapiens means wise humans, and we need a lot of forethought, and that's what separates us from the other species. It's our forethought, and we're not using that because we know the science is telling us that we are coming into catastrophe, and this is our future. This is what we need to be planning for. So to say, okay, I know I'm going to connect it back to your budget and to all your financing about our police, and so I really want to connect it to the police and fire, because that is a big issue about how much of our of our budget is going towards police and fire. And so when we do this investments and create bonds to support these large pensions that they are requiring, we have to really look at, and we're doing that now. We're supposed to be reimagining police because we've had a lot of problems with the police. So when we're going forward and giving them all this salary and all this money from our general fund is very large, the amount that goes to policing. Let's just look at policing. And yet we're having so many problems. And when we look at reimagining like other cities are and other countries don't use guns at all. And we've had 1,000 deaths from police. And, and when so much of our, actually, the conflict of interest comes that the police are funding the campaigns of our politicians. We saw that with Deb Davis.
Tessa?
Yes. Okay. So what I'm saying is the conflict of interest, because when you are deciding how much money goes towards these police retirement funds, we have to really look at the conflict of interest there. So then on top of it, we really need to, reimagine the police without guns and to become, the loving human beings that we need, caring human beings.
Thank you, Blair.
Hi, Blair Beekman here. Thanks for the meeting today. It was very informative. I'll definitely be reviewing this meeting. Thank you. To offer, some ideas of Tessa, to be considering green sustainability ideas in how we'll be financially be planning our future. The choices we make in that financial planning. Just a few reminders that this really can be a time to really start to consider renewable energy ideas. And that I think we've all, the mayor himself made a really good stand about the future of AB 1149 or 1139. That was a very questionable energy bill for our future. And City of San Jose took a really nice, good stand about it. We don't want a future of fossil fuels, and we don't have to work in these kind of mutually exclusive terms. With that said, a polite reminder that we may have to be considering, I try to offer this, possible earthquake scenarios in the next few years in San Jose, how we plan our budget. Yes?
Please.
Man, I am sticking on the point, Chappie. I got a very important point here that we have to plan our financial concepts if we're going to think of those terms. And if not an earthquake in the next few years, then in the next decade, there's natural disaster issues of wildfire and sea level rise that we have to consider and that we will be considering. So just a good luck how we plan ourselves and that we can plan for a renewable energy future. It does not have to be fossil fuel. That's an important concept to build our future. Thank you.
Thank you. Brian?
I wanted to thank you all for taking the time to show this. Those people that that make sure they get the most bang for your buck for the retirements, I can't thank you enough. It's an unthanked, I hate to say you guys have got to learn better vocabulary. You ladies and gentlemen, you keep people in retirement, you keep them with their medical, you have to deal with all those numbers, you have to deal with a lot of grief when the economy goes up and down. I highly respect what you do. I couldn't do it. And I really wanted to say thank you for all you're doing for San Jose and the retired people. Thank you.
Thank you. And that is it for public comment. So we're closing public comment and we're bringing it back to the panel. And if you can raise your virtual hand to speak, and I will call on you. All right, Councilmember Davis, go ahead.
Thank you. I just wanted to summarize a couple of things that I heard and then ask a question of the board that I think is a really important question to, or the boards, which I think is a really important point to get a sense of today. So I heard from Mr. Polani, the CIO, that the likely returns in upcoming years, because we've had a very, very good year, likely returns in the upcoming years are to be lower than average. Did I hear that correctly, Prabhu?
They said, yes, you did. And we expect it to be lower than the past few years. And as you've seen, we have been decreasing our expected returns. And because we had such a good year the past 12 to 18 months, our capital market expectations going forward will accordingly get reduced.
Okay. I'm not going to ask you to get out your crystal ball and say what do you think they will be, but do you think that they are likely to be below our expected rate of return or discount rate? Is that what you were trying to say? I want to just put a fine point on it.
Not exactly. What I was trying to say was, I showed a chart with our current asset allocation, and they had.
Am I the only one who can't hear Prabhu?
It's Drew. He's coming through loud and clear to me.
He's pretty clear.
Yeah, I can hear him.
Can you hear us, Dev?
I just heard you, Chappie, but I didn't hear any of Prabhu's answer.
Hey, Prabhu, try that again.
I'm sorry. My internet connection is unstable, I'm told.
All right, take two. So what I was trying to say was I showed our current asset allocation with expected returns, 10 and 20 years. And what I was trying to say was that because we've had such a good year, in some sense, we've borrowed from the future. And because asset prices are so high, going forward, if you look at 10 and 20-year projections, you can expect those projections to be correspondingly lower. A simple rule of thumb, this is not entirely accurate. If we had a 20% year or a 25% year, divide that by 20 years and accordingly reduce your expected return. So again, just working, back of the envelope, I would say that given the past year and what we've had, you can expect our expected returns going forward for 20 years to be lower by, say, 50 basis points. So instead of 6.5% or so, you can now think it's going to be about 6%. Now, is that higher than the discount rate? And it all depends on what the boards decide the discount rate should be going forward. And certainly those capital market assumptions have a bearing on how the board decides what its discount rate is going to be going forward.
Thank you. I turned off my video and I was able to hear that. So 6% is lower than the current discount rate for a 20-year return. It's lower than the current discount rate, although I will point out that it is higher than what we think that the interest rate is going to be for the POBs. But I just wanted to make that point. I thought it was important. The other point I wanted to make sure to summarize here, remember you said we are in an expensive market, which means we're not going to get the best value for our dollars right now if we invested them, if we had an influx of cash, an infusion of cash into either of the pension funds. Wanted to point that out. The next point, and I can't remember, I think Bill made this point from Chiron, the city always has to pay the normal cost regardless of the funding level. So if we don't match up, and this is me now opining, my understanding from this, if we don't match up the POB term to the amortization or vice versa, depending on who takes action, then it's possible that we'll be overpaying because we will still have that credit. And I think that was the point that that the city consultants were trying to make. We still have that credit, but we would still have to pay in regardless because we always have to pay that normal cost. And my understanding from what Bill said is that credit from the POB does not stand in for us paying annually that normal cost. Did I get that right, Bill?
That's correct. If you can think of it as if the plan becomes fully funded before you're done with your debt service on the POB, your contribution to the plan is going to equal the normal cost. And then you will also have to pay the POB debt service, and you will not get the corresponding amortization credit in the plan that would offset.
Got it. Thank you. I think that's a very important point to make. And then lastly, the advice from Chiron is that the boards would need to agree to that advice, but the advice from Chiron is about matching the POB credit and the amortization rate to the term of the POB. Now, the important point there is the board has to agree to it, or the boards, depending on whether we only use POBs for Federated because they have a much lower funded ratio, or both. So the question that I have, the reason I did all of this summarizing was to lead up to a question that I have for the members of the boards, which is, what are your thoughts on that? Having been at the Federated meeting last week or 2 weeks ago, I can't remember now, I think it was last week, the advice from your fiduciary council was basically to not take that advice from Chiron and to set your amortizations however you want. And so I'm asking, as a member of the city council, if having an agreement about setting the amortization for the POBs specifically, that amount that gets credited, having a specific amortization is something that is palatable to you as members of the board. There was a little bit of a discussion very, very briefly about memorandum of understanding or a funding agreement, and what is your, I would like to hear from the members of the board, and I would say specifically Federated, frankly, because the funding ratio is lower, and I think we are more likely to fund that with POBs than police and fire. But I'd like to hear from the board members about their ideas and thoughts on having a funding agreement or an MOU of sorts specifically related to an amortization and credit for POB funds.
Thank you, council member. Is there a member of the board who wants to tackle that question? Or I see Spencer, go ahead. I see your hand raised.
Thank you, Vice Chair Jones. And I certainly welcome any other trustee of the board to respond. I think our advice at the last meeting was, on the one hand, I don't think we can offer any type of MOU to the city council, that we need to make our decisions independent of the city council, and that our highest fiduciary duty is clearly to the employees and members of the system. That said, I think we value the advice and input from our actuarial council very highly, and I don't think we are adverse to following his amortization recommendation, but that is something that would be decided at a future board, and I can certainly not make any assurance at this time. I'm not sure any other trustee would either, but I certainly welcome their views on this.
Thank you, Spencer. Drew, I see you have your hand up.
Thank you, Mr. Vice Mayor. This conversation is deeply philosophical. So, Dev, I'll make you a deal. And if you can tell me that the future will pattern-wise match the past, I can promise you anything you want, right? But if the future doesn't match the past, which, by the way, is how we got into this mess in the first place, I can't. I don't know what the future will bring. And so I can't tell you that I can meet that. And that's the issue. The philosophical issue is POBs are an absolute no-brainer. If you tell me the future will be more or less like the past, that's what Peru said. Shoot, we can model this out for all time, right? POBs make perfect sense if the future's like the past. But we got in this jam in the first place because Well, I think it was Mark Twain, the future doesn't repeat itself, but it rhymes. It didn't rhyme this time. And Bill pointed out why, and so did Cheryl. And that's the issue. So I think really what you're asking for, Devin, I think we can do this, is some kind of an algorithm, some kind of set of rules. If this happens, will you keep the amortization schedule constant? Sure. Right? But then I could say, well, if something happens we haven't forecast, will you let us, working with you, adjust that as prudent? That's the problem. Does that make sense?
Thank you both.
Thank you.
All right, thank you. Councilmember Cohen.
Yeah, thank you. And thank you for the thorough discussion. And I appreciate all the modeling and historical context, particularly the discussion about 10 and 20-year cycles. I heard in there the part about no 20-year cycle had or only one, I guess, 20-year period had a loss if you were to invest in a 20-year period. That 20-year, that was based on a net zero, right? With that, not based on a paying back a interest rate on a POB, right? So there's a base amount that we have to recover in order to make sure we don't have a net loss here. So is there? So I just want to make sure. I mean, I'm fairly comfortable with projections of 6 to 8% over annually over 10 to 20 year period. But I just want to make sure that I understand comfort levels of that 3.5% built into those models. So probably you can address that a little bit.
Yeah, so I just gave that as an example of what happens historically in terms when you invest in an expensive market, that you could actually have a negative return. And that did not have any kind of a 3.5% built into it. It was just the price at the beginning and at the end. And also I did make the point that that was a nominal return, not a real return. So if you actually factor in inflation, that return would have been even lower. So it's just to show that it's not wise to invest in the market when it's very expensive, especially over shorter time periods. Now, I also have to add the caveat that here we use the proxy as the S&P 500. And as you all know, our asset allocation is not just public equities. We do invest in a variety of asset classes, which cushions the blow in a downturn. But again, I was just trying to illustrate the point that it's never a good idea to invest in very expensive markets.
And you presented a wise asset allocation, which obviously would balance out and would be unlikely, even more unlikely to have that kind of negative return than what you presented. In fact, I'm very confident you had projected a 6.5 to 7% average rate of return, which I, based on my experience over years, is a pretty conservative estimate. So I'm feel like it's a fairly reasonable assumption for that allocation that you showed. And then the other thing I wanted to point out, and I don't think this was talked about much, the proposal here is not for us to buy into the market all at one time, right? I mean, we're talking about a dollar cost averaging and some kind of multi-year buy-in with this program. We wouldn't be buying in, for example, buying some amount of bonds and investing everything right now at this peak of what we think might be some high level of market. We're talking about a multi-year investment strategy, right? Someone want to address what kind of strategy we're looking at?
You mean in terms of the city issuing pension obligation bonds?
Issuing and then investing, right? We wouldn't be issuing and then potentially putting all the money into some investment right here in next month or right at one time, right?
Yeah. So part of the policies that we'll be bringing forward will be addressing kind of what those funding levels would be, what the market looks like. But as I pointed out, the policy would never assume that we would fund 100% of the unfunded liability at one particular point in time. And so rest assured, while we have an unfunded liability, around $3 billion, we would never bring to you a POB for $3 billion for lots of reasons. So yes, it would be something that we would look at, each at different points in time. What is the funding status? Is now the right time to issue pension obligation bonds to help bring the funds into better funded status? So it would, and then because we would hand over the proceeds to the retirement boards, then they would have those investments to make at that particular point in time. So
right, I wasn't even talking about the total amount. I mean, even if we say we're just going to do 1 billion and we're not going to do the entire amount, I assume maybe it's a question for the investment board. The board itself wouldn't be necessarily investing it all in one lump sum, but having some strategy to invest it over time in order to make sure that we're not trying to time the market with a single lump investment at one time in order to be safer. If you invest over a 2-year period, you're not running the risk of buying at a peak but maybe I I see Drew's hands up. Maybe he has some input on this issue.
Drew, did you want to address this issue, or?
Let me give you two quick answers, Councilman Cohen. Yeah, in fact, the reason you had great returns is because we didn't try to time markets, and we try to think very thoughtfully about this. So no, I think you can safely assume we would think very deeply about how we would sequence that money into the market to get the best return. And again, over 10, 20, 30 years. You asked a question of Prabhu, and I think Prabhu is being very diplomatic. So I can answer your question directly. Had you invested money over a 30-year period, any year starting back to before my parents were born, the Great Depression, 1928, based on data from our consultants who are sharp people and have all this history, whether you factored in inflation or not, actual return or real return, there is no period in which you would not have returned more than 7%. Now, again, this is deeply philosophical. So again, if God comes down tomorrow and says, yeah, the future will be kind of like the past one way or the other, this conversation isn't taking place. It's a no-brainer. And so what we're worried about in this conversation is what we don't know. And as Bill pointed out, we got bitten by that 10, 20 years ago when everybody said, well, inflation's always been 5 or 6%. It'll always sort of average out 5 or 6%. It hasn't. Inflation is doing something we've not seen at least since 1928, maybe, I don't know, maybe since the Roman Empire, right? And we got in this jam because we forecast prudently. You guys did, we did. And then somebody threw us a curveball. So yeah, if the future's like the past, this is easy. It will return 7%, but
yeah. I guess what I'm suggesting, of course, is not that we don't have to return 7% in order for this to pay off. And I'm just talking about these numbers and historical returns. Obviously, nobody can be 100% sure. The other thing I'll just point out, of course, is that, well, two things. I just want to just go back to the first point, just to make sure that we're not scared away by this idea that the market's expensive now. We're not going to be throwing all our money into the market at one point. So just to make that clear. But secondly, if the market somehow has something out of line with these historical trends that you will always over 30 years return this amount, that will affect us whether we do this or not. I mean, the pension problem will get worse because we won't meet our projections if we're below the 6% either way. But if we're below 6% and above 3.5%, we will still come out ahead on the bond portion by doing the pension obligation bonds, while we'll be negative either way on the other portion of our investment, right? I mean, so we run a risk regardless of whether we do the pension obligation bonds if the markets don't pay off on a typical trend. So I just want to make that clear. We will be hurt on by poor returns, whether we do this or not. But the question is whether or not we have some level of confidence that 150 years of trends are a reasonable risk for this portion here, which is trying to supplement our deficit through this mechanism, right?
I don't mean to monopolize the floor, but so for police and fire, we give the presentation. Smart, Councilmember Cohen. So you could say in a shock, we have a bigger pool because we took a POB. How much more do we lose? If you've got a 20% hole, if you got a big, it's negligible. So we can analyze that. And your instinct is right. You get hit either way, but a bigger POB, at least 5 or 10% bigger, it's negligible. It's almost down in the weeds. I think also, Councilmember Cohen, I think we're doing the right thing where we're separate from you, from Julia, and that's right. But once I think we agree, once you say we're going to do this, we're going to sync up with you guys, with Julia, right? And as you say, if we say, I don't think this is a good time to give us the money, hopefully the city will say, okay, the interest rates are holding, we're not going to issue now. And the place we get in trouble, of course, is if the interest rates on the bonds start to go up at a time when we don't want to invest the money, then I think we put our heads together and figure out what the right strategy is. And it very well might be to issue the bond and put the money on the sideline for a bit. And it was money on the sideline that gave us these excellent returns. So we're pretty comfortable doing that.
Great. Thank you so much.
Thank you.
Thank you, Councilmember. Councilmember Mahan.
Thank you, Vice Mayor, and thank you all for the presentation. I appreciated how detailed all the slides were. Certainly felt like I learned a few things. So I appreciate that and appreciate my colleagues' great questions. I wanted to start by picking up where Councilmember Cohen left off. My understanding from our last study session was that the success of the POB here would really largely come down to returns in the first few years. I recall that from some of the scenarios I believe we looked at earlier in the year. And I'm not sure if I missed it, but I didn't see that repeated today. Could someone talk us through that particular dynamic?
Wingsie, was that you or Julio that had those slides in April? I can't remember.
Yeah, I mean, certainly we'll be digging and diving a lot into risks, right? And this conversation is sort of the starter. And so there's a lot to talk about. There's the borrowing side and then there's the investment side and what the risk is with the investment side. So yeah, I mean, it's the leverage that we've been discussing, right? That Drew just said. The more you have when there's a shock, you've got a larger pool. And so we can get into that. However, other things like the discount rate or as Councilmember Cohen said, not having good returns is affecting the plans in general. And the goal here is to get to a healthy funding status and also for that budget stability and cash flow stability. But yeah, so there's a leverage factor of, right? There's a leverage factor of if your portfolio is larger, just as there's a huge shock, then you're going to lose more than if that portfolio was smaller. And same on the flip side. If the shock is upwards and there's a huge gain, then you would have gained a lot more than if you had a smaller portfolio.
Yeah. So my recollection from the slides that you're referring to, Councilor Mahan, was to show that over the term of the POB, you could have the same average rate of return over that 20-year period, but depending on what you earned in each individual year, it could have a difference in how it impacted the UAL.
That's right.
Better returns at the beginning are going to have a more positive impact as opposed to better returns at the end. So that was what you were, I believe it, my recollection is.
The other piece though, Julia, was the cushion though was really important, right? So I think we've been talking about the borrowing rate and how important that cushion is. Your borrowing rate. And so all of that factors into the ultimate ending portfolio when we go back and analyze the success of the pension obligation bonds.
So right now there's like 300 plus basis point spread between the discount rate and the plans and our borrowing costs.
Sure. But I think I appreciated how Drew, articulated the fact that we just, at least my view is, I'm a little skeptical that we should look forward and say that 100 years worth of data points is sufficient here. I mean, these dynamics change, and we really don't know what the world ahead holds. I guess, as I understood it from April, I mean, it actually, what part of what concerns me about this potential strategy is that it actually is fairly dependent on timing. I guess I'm somewhat disagreeing with the way that I thought I heard Councilmember Cohen characterize this strategy, because I thought, I don't, if I'm mischaracterizing what you said, Councilmember Cohen, please tell me, but it sort of was implying that this is just, if we stay in the market, if these investments are over 15 or 20 years, we'll probably be fine. But actually, because of we're taking on a debt where we're going to owe a fixed debt service, and then what happens in those early years due to compounding effects could have a very big, have significant implications for whether or not this is successful. Is that correct? I'm seeing heads shake both ways. So
I mean, I don't know who you're asking.
Yes and no. So could somebody explain to me? I thought actually timing from April, one of my takeaways was that timing actually was pretty critical. And if we had a couple, 2-3 really bad years early on, we would maybe ultimately lose out on we would not see any net gain from issuing.
I don't know if you want me to take my first crack at it, since you were kind of asking me first. I mean, my point, and I think Drew said this too, you don't necessarily invest it all at once. You borrow it all at once, and you invest it. You can invest part of it, hold some of it, invest it at various times. So because you might have some downtime doesn't mean that you're taking the hit on the entire investment. And because you invest it at various times, you end up with some of it actually investing at lower points that causes actually some gains when the market goes up. So you don't necessarily take all that hit by borrowing it now at a high point in the market. The point is that you borrow it at a low interest rate time, but the investment board will decide when is time to invest it, and you invest it over a period of a few years so that you're not necessarily investing it. But anyway, I'll let Drew maybe give some more information.
Well, I actually want to ask Prabhu. I mean, I understand your point, but we nonetheless we have to pay that 3% or whatever it ends up being. We have to pay that debt every year, whether or not we've invested the proceeds. So I guess, Prabhu, could you tell us a little more about this concept of dollar cost averaging? I know Vanguard's done a lot of research on this, looking at different scenarios over 10, 20, 30 years. Does it really, is there as much protection? My understanding is it actually reduces both downside and upside. I'm not sure how helpful that is to us in this scenario.
Yeah, look, I think the entry point is very important. That was the point that I was trying to make. And I think Chairman Lanza was trying to make the point that regardless of your entry point, if you actually hold out for 30 years, then you can still get that 7%, right? If the future looks like the past, right? And we don't know that, but we do have 150 years of data, right? But over shorter time periods, and that's what the data shows, that 5, 10, 15 years, you could actually end up losing money, right? And so that's something that I just wanted to point out. And the reason to point out all this is just to share that when we make a decision, when we recommend to the board's various options, we study the data very carefully. It's a very deliberate decision. We take our time in doing it. Now, we haven't followed, in the past, to my knowledge, we haven't done any dollar cost averaging, right? So I think that would be really, I'm sort of going out on a limb here, and forgive me if I am, but it's up to the city to say, look, we're going to issue X, dollars, and we're going to do it in tranches, and we will give you the money in tranches, which means automatically there's some kind of dollar cost averaging applied to the money that we get. But for us, as far as we are concerned, and I mean, I'm just giving my opinion, and board members correct me if I'm not talking for you. But as far as I'm concerned, if I get a pot of money, we are managing $8 billion. If I get another 200 million, I manage now $8.2 billion. And I take a look at that pot of money and decide what's the best asset allocation going to be for that. Now, we can certainly, and this is something that we have discussed in the past, we can certainly link to any proceeds that we get to some kind of, is the market very expensive? How do we now deploy these proceeds? But those are conversations that we need to continue to have.
Can I jump in? So let's not use the term successful or not, Councilmember Mahan. Let me be as crystal clear as I can. Assuming the future is like every 30-year period, starting with the period that started in 1928, this always makes a lot of sense. Always, 100%, guaranteed. We can go back and look at the data and say, well, have we paid 3% on the debt? How much would we have returned? Now, you heard correctly with Councilmember Mahan. I had the numbers here and I can't find them. If I remember this right, maybe Prabhu, if you look at the delta between the best of those 30-year periods going back to 28 and the worst, I think the best you would have gotten 20 times your money, and the worst you would have gotten like 4 or 5 times your money. So you really would love to put the money in on that best one. That's a big delta. But if the future's like the past, this is a no-brainer. I'm hammering this home that the thing we have to deal with is how we got in this mess in the first place, which is the future isn't like the past, and how do we deal with that?
Well,
I'm sorry for hammering that point again and again.
Yeah, I appreciate it. That's actually the point I'm trying to make, is that I for one don't have a tremendous amount of confidence that the next 30 years will look like the last 100. We have declining birth rates. We have people living long. We have a lot that has changed fundamentally. And I'm not an actuary. I'm not a demographer. There's a lot of things I don't know. But my understanding is we're looking at a 15 to 20 year period here, and I have no idea and no reason to believe that past data, past performance is indicative of what the next 15 or 20 years will look like. I see other hands, so I'll pause there and see if others wanted to chime in.
Yeah, Julio, I see you raised your hand. Did you want to address Councilmember Mahan's question, or?
I'd love to just kind of a slight refinement, because I think the way we approach this, it really is an intellectually honest conversation, but they're somewhat different. One is you're taking a loan that you have for a past due amount. Let's be clear. This is a past due amount. Every employee has already earned this benefit, as have the retirees. So it is forward looking, but we're paying off a past due amount, and we're on a payment plan of 6.625 at a much lower rate. Those economics, those cash flows will work no matter what. That's how a traditional refinancing would work, council member. However, what makes it somewhat unique is it isn't a traditional refinancing. We're taking a pot of money and giving it to the two boards and having them invested. So then what I was asked by the city is, well, give us an analysis of whether it works out better. And it's a little different because it is a mixed portfolio of fixed income, other assets, and the equity market. And you compare that lump sum amount that Wingsy was talking about leveraging this. Let's think about it this way. You take $25. I have a 6-month-old child. I take $25. I put it into an account. Was now the right time to do it? Next week or 6 months? That's kind of the decision. But I think everyone agrees in most cases, if you do it now, as opposed to 6 years from now, it's going to grow more and more. So that power of compounding is what the POB really provides. And Drew keeps on driving home that point. There's a power of compounding that works to your advantage. But then we also stated that power of compounding is also highly suspect to market timing, right? Clearly, it's much better for you to issue POBs last year when you had this great return, and you're going to get this great head start. And then I'm going to address your point. Great, Julio, but we don't know where we are going forward. right? So then we said, well, what are the types of solutions we can have? One is this idea of doing it over time, a dollar cost averaging, investing over time. And Drew said something that to me was in part for using your first name, Drew. But a really fantastic comment that gives you some flexibility, which says, well, maybe we believe, the city believes it's a great time to issue, but the investment side, because they don't necessarily align, believes maybe it's best to hold it in cash or a certain investment for a certain time. So what I find encouraging is that the prospect of this is that you're seeing it's one complex, requires some coordination, and can probably come to that solution. I don't believe, certainly as advisors, we ever tell people this is a panacea and a fail-safe. But generally, with very low, historically low interest rates compared to what they were before, it is far more compelling and much more likely to give you positive results.
Sure, but I'll just add that in your scenario, you said you took $25, put it into an investment account for your child's.
I hope it's more. I need more.
You're going to need more than that, but I'm doing the same thing with my kids. But what you didn't say is that you borrowed at a 3% interest rate to put it to invest it. And so I understand the power of compounding, but the combination of future uncertainty, the market being pretty pricey right now, and the fact that we're obliged then to pay a fixed interest rate tells me that there's more risk here than you just taking $25. I mean, I think your scenario was a little.
Well, I was breaking this up in two parts. Because remember, the first part we refinance at a lower cost, and the second part was what is the outcome of the investment decision. You're absolutely right, but I'm trying to break it down because that liability, you're going to save money anyway. 3% versus 6.625, you're saving tons of money. That's like me taking money, the opportunity cost of investment. I was trying to break it up into these component parts because it gets to be difficult.
Right, but in that scenario, you're assuming, sorry to interrupt you, you're assuming that we're going to achieve the 6.25, 6 point whatever percent you just said. That's an assumption.
Well, no, your UAL payments are set at 6.625 and an escalation factor of 7.25. Those are your past due payments. I'm not talking about the future. That's another same 6.625, but different. Your payment stream that goes from $304 million up to $347 million each and every year are fixed dollar payments. And we're trying to lower that fixed dollar payment stream. That would be a slam dunk if it was traditional refinancing that Julia and her team has done a number of times. What makes this somewhat different is the money now goes to an investment board.
Yep.
And I'm trying to break up those two little components.
Yeah.
And it gets to be, unfortunately, a little complex. And I can't get you an absolute result.
Right. Okay. Thank you. Well, Chair, I'm at least done for now. Thank you all.
Thank you. Drew, I see you have your hand up. No. Spencer?
Yes, thank you. I wanted to make a few comments. I think we need to carefully think about the separation between short-term results and long-term expectations, because I think that will figure largely in how a future city looks back at this decision. We use a discount rate of 6 5/8% because we expect to earn that on average over the long term. But year by year, that is going to vary greatly. And the question is, in issuing a bond, you're not simply refinancing from a higher rate to a lower rate, as if you were refinancing a fixed rate mortgage from 6% to 3%. You're exchanging a variable rate for a fixed rate. You're adding leverage to the system. When you borrow, you add leverage, and you add leverage means you're going to goose your returns to the upside, and you're going to goose your returns to the downside. So the question is, while my fellow chair Drew is absolutely correct, over a 30-year period, this is probably going to pay off if the past is anything like the future. It is a fact that in the short term, we could be underwater for several years. So how many years underwater will you tolerate before you decide this was a good decision when we come back and start making money? That is the issue at hand. We have no way, absolutely no way of forecasting our returns this year, next year, and the year after. We think we have a guess at long term, but it's speculative at best. So I think that's the thing to consider. The other thing I would add is in any financial decision, you need to weigh risk and reward. So there's considerable risk here, as I've just explained, but what's the reward? What's the upside? If we were to take, I saw some analysis on a $250 million POB for Federated. A $250 million POB looks like it might reduce the city's annual payments on the order of single-digit millions per year. And single-digit millions, that's more than I take in a year. That's a lot of money. But in the context of a $400 million annual commitment by the city, it's kind of small beer. So how much risk are we going to take to have a $9 million improvement year by year? I think those are the big picture issues here. And I'll pause for now.
Thank you, Spencer. Councilmember Peralez.
Yeah, thank you very much. And I was myself getting nervous on the questions that Councilor Mahan was posing because I saw heads going different ways. So I think it describes how complicated and certainly what perspective you may be looking at this from. That the responses could be slightly different. And that, obviously just describes how complicated it is, even for experts on the panel, more experts than me at least, to maybe have a slightly different take on the questions that Councilmember Mahan was posing. I do think in the descriptions, though, everybody seems to be on the same page in regards to what we're looking at. It's just a matter of how you're describing it and where you're looking from, and then how far you're looking out. I think that one of the factors for me that is existent regardless of our opinions is that we're in this boat whether we like it or not. And so the decision to both issue pension obligations and then the decision to invest those dollars is done, right? We all got in that boat long before maybe any of us were involved here with the city. And now, right, we're sitting with, if you want to call it sinking, right, but certainly considering the unfunded actuarial liability that exists, it's there, right? And so there is no sort of removing us from that situation and going back to a clean slate. And we know what it looks like to continue down this path, and we're making assumptions on the market today, right? I mean, the board is having to make decisions on where they invest, what they think returns will be. Certainly, they're more longer term. I would say we as a council should be looking long term as well. We're making the obligational payments year over year, and those have an impact on what we're doing. But we're also trying to set up the city for success, 15, 30, 50 years from now. And I think that's what makes these conversations so challenging. And at the same time, I think the best recognition that I've had is this is why I don't manage my own finances as far as pensions go in future investments, because it truly takes an expert in the field to be able to weigh out all of these scenarios and risks and rewards. And then ultimately, the owner of the dollars has to make their decision, right? The best decision. So I appreciate the report here, the discussion today, because that's what you're helping us do, maybe as individuals that are not as intelligent when it comes to this conversation, to be able to understand the risks, understand the rewards, and then make a decision on what we feel might be the best path forward. And how we put ourselves in the best position, as well as all the city employees that we've have obligations to, and so I appreciate that. I think it's been very helpful, all the conversations and where we've come to date. I still personally think that issuing the POB is the route to go, and I would agree that having that separation of decision where our boards are able to then act on those decisions is important and is a key factor of this. But I also think, and I appreciate Drew for saying it, that the collaboration has to be there, right? And especially once we've had that already, but when and if we make this decision to issue a POB, I think it has to be right even more closely connected in regards to those discussions, what's happening with the dollars, much like an individual like myself, would potentially be investing my future or my pension with someone and really having to be knowledgeable about what's happening. And so I appreciate the back and forth and the dialogue, and I look forward to hearing thoughts from my colleagues. Thanks.
Thank you, Council Member. I'm not as gung-ho or on board with the concept yet. And so my question, and I'm going to address this to Julio or Wing C, since we have you, what type of even framework should we be looking at in terms of even being able to make this decision? The only thing that I'm landing on now is just each individual council member's risk tolerance. So I wanted to get some insight or feedback from either one of you in terms of, with all this data and information and all the comments that we've heard, what would be our framework? And again, I know Julia's going to touch on some of this when she wraps up, but what kind of framework should we be looking at in terms of even making these types of decisions?
At the end of the day, you asked a really good question. I think, frankly, you distilled it to some point. It really does depend on your outlook and your perspective towards risk. You're making an investment decision. But if you're to ask me the most direct question, no one here says they know what the future will look like. And it really does depend somewhat on your perspective. But I think it's important to note, maybe to take a step back and say our whole process, and I thought today we were looking at an amortization policy. And I think we agreed with the actuary that being able to match the terms allows you to shape cash flows. We thought that made sense. And I'm going to step back before that, when we worked with staff for a number of months and looked at every other solution under the sun and said, what else can we do to make a meaningful impact? Because we know at the end of the day, you have this past due payment with pretty significant amounts, and you'd like to have some operating flexibility. So we look at the objectives, but then you're saying, do we have a set determination as to the risk or timing? I think part of it is, if you issued last year, it would have been a great idea. And everyone said, this was great. You look great. But we all know we don't have a crystal ball. So I think some of it is looking at saying, not just this risk, is it going to be a positive outcome, but what is the true operating confines that you work in, council member? The truth is, having been in government shoes, this idea of theoretically thinking of things doesn't solve payroll. It doesn't solve all the budgetary concerns and all the other things you have to do as a council to meet all the other objectives. So they have to be balanced within your policy context. And then truly, I think you distilled it within a collective objective of what your risk tolerances are and your outlook. I don't know if anyone would disagree. I can give you ratios, and it's great and interesting to look at those P ratios. And people will tell you that clearly the market looks, that it's performed well, and your sentiment might be that maybe it makes sense to have some timing or to hedge a portion of that. But I think it is that kind of collective decision is where you all come in like any other council decision. You come in a room, you have your different perspectives, you vote on it, and you kind of move forward, or you come up with a compromise solution. I can't give you a set answer, but I do think it's a confluence of factors coming together.
Great, thank you. Wing C?
Yes, just to dovetail off of that, I think from the city's perspective, it is about how do we pay this outstanding bill, and POBs is not the one answer, but that the development, as Julia was talking about, the development of the pension funding policies, and under what scenarios would the city council consider issuing POBs? We know what pitfalls happened in the past in terms of the risks that we're taking on the borrowing side, that we could put parameters around with the pension funding policy. But I think right now we're at the point of Do we want to add this to the toolbox? We're not really near the point of we're going to be issuing this next month, but just looking at this outstanding bill and figuring out, okay, we've got multiple strategies. Do we want to add POB as part of that strategy in the toolbox? And when would we, what would we do? What are the scenarios? And I think same for the boards, right? Policy around what would happen if the boards did receive POB proceeds in terms of how to credit that, how to invest that. So I think we really are looking at policy development at this point.
Thank you. Drew?
God, I feel like I'm monopolizing this. I don't mean to. So I think that's exactly the right question, Mr. Vice Mayor, is how do we get at this risk? So already I've told you how to bifurcate it, right? So if the future is like the past, this is an absolute no-brainer. In every scenario, this is a genius move. So we can get rid of that. That's gone now, right? And I urge you guys to do all that homework yourself. You can do it in 5 minutes in an Excel spreadsheet. So the question becomes, right, the risk of the unknown future. God, how do you deal with risk of the unknown? Well, we got this black box, this pension system, and we're not quite sure what's going on in the world around it, but we know bloody well what's happening inside that black box. And there are only 10 variables of interest, and we've talked about all of them here today, right? Interest rate, in the markets. I'm looking at my screen. I've got them right here. Inflation. You want to talk about an interesting risk, Mr. Vice Mayor. We can analyze what happens if 5 years from now somebody cures cancer. That's going to cost us money. Good. Our policemen, our firemen, our Federated folks, they're going to live longer. They're good. We're happy for them. That's more money, right? We can analyze that, right? I mean, the future is uncertain, but it's not unknown. Its variability is knowable, right? Now, World War III, we're all screwed, right? There are black swan events, but I don't think I think we have to look and say, well, should we have seen this weird dip in inflation coming? I can tell you we've analyzed that at police and fire, and we reacted. I think you guys reacted too, right about the time you would have noticed, gee, it's not doing what it did before. Right around that time, we reacted to that. Most people in the financial world did too, right? A lot of other pension funds didn't. I think that's one of the reasons we're doing better. We can get at risk, but that's going to take time. We got to sit down and do the work if you want to. Or trust your gut, which is probably almost as good.
Don't want to do that, but thank you, Drew. Councilmember Davis?
Thank you. I don't want to step on your questions, Vice Mayor, but the question that I have as part of this discussion that I don't think has been asked in exactly this way is, under what scenarios or what would happen to actually cause our general plan, our general fund, to have a higher outlay under POBs than a lower outlay, which is frankly part of what we're looking at, the reason that we're looking at doing this. So the retirement boards are already trying to smooth our contributions, which is great, but they won't be smoothing our contributions, including our POB, our payments to the POB. So I want to really probe, under what scenarios will the general fund be on the hook for a higher amount than we expected if we had not done POBs? If we do the POBs, than if we had not done. And I'm sorry, this is seems like a very confusing question, but I'm trying to get a sense of the risk in a different way. The risk to the general fund, especially in, frankly, what I think I and my colleagues are probably most concerned about. Even if we come out ahead at the end, I don't care if it crunches us a lot in the current, in the very near future. That's more painful to me than even if we come out ahead in the end. So that's my concern. And I think when I hear Prabhu saying, in upcoming years, returns are likely to be less than we expect. That's the thing that's giving me pause here, because if they're less than we expect, then that sounds to me like that's a bigger outlay in our general fund, because we will not make our expected returns. It'll add to the unfunded liability, even though we've just paid it off in our minds. It'll add to it, and we could have to pay more out of the general fund. So I'd like kind of confirmation that I'm thinking about this in the right way.
Who wants to tackle that? Julio, I see you have your hand up. Go ahead.
So I think this is probably one of the more confusing points that people should understand. One, there are a number of factors that are going to happen regardless of whether you issue pension obligation bonds or not. We are only talking about the investment side. So let's be clear. Any kind of impact on disability, raises, any other kind of factors of mortality are going to happen regardless. Bill, these are things that he's going to say, this impacts your liability. Your payments will go up because of those, but have no impact whether you do POBs or give them an extra $10. Anything that changes your liability, you can't. Let's take POBs out of the equation. Let's just say you gave $10 million from your reserves. Would that have somehow changed the outlook? No. That's an important thing, because a lot of the time it does not do that. Now, on the investment side, as Wingsy said, if you leverage and you give more money and that money now gets lost, you're now going to lose and have some impact. Is it likely going to eliminate the cash flow savings that we're projecting? Because the cash flow savings that we did in some of these projections are from $8 to $50 million. What kind of impact will an additional loss have? Remember, the loss is only on the $200 million of the pension obligation bonds that you issued. The other portion for the other $8 billion that Prabhu was talking about are going to happen nonetheless. The leverage component is on that $200 million. It is very unlikely. So you'd have to lose a significant amount for you to really lose it all, excuse me, and to be worse off. So 8 billion versus a couple $100 million, most of the loss will be down to what's already in the account, not to the pension obligation bonds. And that's when we say, if you lose 20% in 2 years, all the savings go away and you're likely back to the same level. But the likelihood that you're telling me that we're going to be much worse off, that typically doesn't happen. It has happened for every pension fund, I will tell you this, throughout the country. And they may have issued pension obligation bonds or not, but in most cases, other entities next door were in the same situation due to some investment losses, due to additional benefits, due to changes in assumptions. All those things, the changes in assumptions, the increase in mortality, all those type of things were going to happen nonetheless. So that's a very important thing for people to have in the back of their mind, because we have a number of clients who issued pension bonds back then, but there are changes that happen. That's why I use that credit card. You pay off your entire credit card. The next month you go out, you're like, well, I paid off my credit card. Well, yes, that was just a past due bill for then. So I think that's an important thing that the rating agencies want you to know. You paid off your past due bill. What's your plan going forward? Because we know it's not static. We simplify things, but we know it's going to go up and down, and only a small portion will be attributable to the fact that you made an initial investment or an additional investment with pension obligation bonds. The majority of which, as you're 85% funded, 85% of that gain or loss will be attributed to the assets already in the account. I hope that answers most of your question.
Councilmember Davis, did that answer your question? Or
it looks like Bill wants to weigh in. I'd love to hear from him.
All right, Bill.
Yeah, I just wanted to add, once you have some more specifics about the parameters of the POB you're looking at, then we could run some stress tests both with the POB and without the POB, so under different economic scenarios, so you can see what it would take for that to happen. Julio's absolutely right. You know, changes in mortality, disability, that's going to happen whether or not you issue the POB. So it's largely going to be based on what happens on the investment side, and we can just run different investment scenarios so that you can see what happens with returns in the short term, long term, but it's going to depend on the size of the POB and how it's structured.
All right. Wingsy, I see you raised your hand as well.
Yes, I heard the concern around sort of the near-term crunch on the general fund, and just wanted to highlight, and I don't know if Bill would want to add to that, that luckily, right, they're paying attention to the immediate impact to the general fund. So when there is a loss or there is a credit, it is amortized over time so that it's not so volatile to the general fund year by year based on that particular year's return.
Thank you. Julio, your hand is still up. Did you wanna? Or Trustee Elaine, go ahead.
Hi, thank you, Vice Chair. Vice Mayor, I wanted to ask, I think the advisors or the city, perhaps, if you could help me understand or articulate what a successful POB issuance and experience would be. Because my guess is that not all of us will be around when it's time to be accountable as to whether this was truly a success or even a middling success.
And who wants to tackle that question?
That's a really great question. I think the analysis that the staff asked us to do, remember once again that refinancing part, but what if you gave the funds $500 million? What would it be better off to give them the $500 million or make the regularly scheduled payments? That's kind of the analysis. But I actually think this is already part of a success and very different from what was done before. And this is why we talked about POBs 2.0. We learned from the past and are doing things very differently. So all the things that people did in the past and didn't have these kind of, one, they didn't have this huge Brady Bunch screen with everyone that you could see at once. But the point is you didn't do these study sessions. All these things were not done in the past, and all the structuring considerations have been avoided. So I think you've set yourself in the right position. You're going to draft a policy, and this is really thoughtful thinking. That's the most important thing. We as financial advisors often believe that the key strategic decisions are often made during the planning phase in this discussion part. So I'm going to say, I think we're starting off in the right foot. And now we're asking the most fundamental question: when's the right time? What's it going to be like in the future? How much and when do you issue? Those aren't yet to be answered, but you're asking the right questions. And you may not have the right answer, but I think most people, at least through my training, most people think about it. If you think intently, if you think strategically about your decisions and feel comfortable about that, that's going to tell you did the best you could given an uncertain outcome. And we all agree that it is a somewhat uncertain outcome. So I do think our process is very well refined and getting better and helping us to that right solution. Wingsy, do you want to add?
Oh, just to answer Trustee Orr's question about how you would know, in 15 years or 20 years. I mean, some of the case studies that we brought to the April study session will look back, right? If it's easy once the POBs have matured and you kind of look back and compare, as Julio said, what would have happened at the end if you hadn't issued and you just stuck with the payments versus what happened with the POBs. And so hindsight is 20/20. Looking back and doing the analysis is easy. It's more difficult looking forward. And so the intent of when we do the risk analysis is, yes, we could do stress testing. What happens if it's this percentage next year of earnings, the following year this percentage, the following year that percentage, and do the stress testing. But the key part of the analysis and why we do the Monte Carlo is like, okay, let's look at 10,000 scenarios based on a volatility. At the end of the day, what is your percentage of success? And it's going to be some number, and then it'll be up right to the city council. Do I like that number? It's not guaranteed, but the likelihood of success is 80%, 90%. Is that, do I make a decision? How do I make a decision based on that?
Thank you. That's helpful. And I'm somewhat pleased that I don't have to make that decision. Having been through the working group with many of the folks on this call, we went through a number of different options. None of them were viable. So I do appreciate the term that this is kind of the last tool in the toolbox, but that also somewhat implies that it wasn't our first choice, which is probably why we're all wrestling with all of this to a great degree. But I guess I'm just oversimplifying. The fact is, we've got a big debt to pay off, and by doing some additional leverage, that's a choice that the city will make. And from the board side, as those funds, those total dollar amounts become more transparent, or even some proposed scenarios, we can certainly do the heavy lifting and work. As Prabhu had said, we and the city, everyone has that experience of already receiving $400 million slugs of assets on a periodic basis. So I'll leave it there. Thank you.
Thank you, Drew. I see you have your hand up.
Yeah, you're asking all the right questions, Deb. I can give you one tiny piece of data that we covered at our last board meeting, which is kind of relevant, right? You can say, well, all right, so I don't put it in POB, or remodeled a $250 million POB for police and fire. And you can say, in a typical market drawdown, which we model all the time, is how we pick our discount rate, am I better off having done the POB or not? Our reference drawdown is 25% decrease in the market. And the answer is you're always better off having done the POB, because even though the bigger pot went down, right, the forecast will say, well, it'll come back again if the future's like the past. And so the amount of money you will have to put in is less if the market goes down when you have a POB. I know that's not really clear, but again, we keep going back to this thing again, which is, if the future's like the past, this is really easy. And so you're asking all the right questions. Well, what if we start out in the wrong time? What so on? But the numbers, the model says we're always better off with a bigger pot. I'm not advocating for POBs. I'm just saying what the numbers say.
Thank you. Elaine, you still have your hand up. Did you want to say anything else, or? Okay, well, thank you, everyone. I don't see other hands up, so we are going to now go to the last section of the meeting, which is the wrap up and next steps. And Julia?
Okay, perfect. Thank you. I think this was a good conversation today, and I appreciate everybody, focus and spending the time. So on the next slide, I think what we've shown during this is we do have some goals that are aligned. We, reducing that UAL and improving our funding plans, also mitigating the future volatility for the city related to the annual UAL payments, and using those savings to, potentially amortize the unfunded liability and accelerate that, and then also easing current budget pressure so we have more resources available to the community. And the retirement plan, in terms of their positive impacts, obviously a large infusion of cash makes new investment opportunities available for them. We talked about doing that once or over time, and then also increasing the funding levels for both retirement plans and reducing the reliance on city contributions going forward. And as we mentioned, before we can do anything, we have to get a positive validation, favorable judgment from the courts. So council directed us to prepare those documents back in May, and before the city council meeting on Tuesday is the actions to proceed with the validation process. And then if and when we receive a favorable judgment, we'll return to the city council with recommendations depending on those market conditions. But in the interim, we have a lot of work to do regarding our policy development and working with the retirement staff and boards relative to developing those policies. So this is kind of a preliminary timeline, which assumes that we will have 4 to 7 months to get a favorable decision. So we expect to file that action after the council assuming the council approves our recommendation on Tuesday. We have 60 days from the time that the council takes an action for us to file in court. We plan to meet with the various bargaining groups before we actually file in court, so they understand and get some of this background information that we have presented both to the council, the boards, and through this study session. So as I mentioned, we will plan to bring back a pension obligation funding policy to the council in the early part of calendar year 2022. And then assuming we have a favorable judgment to bring forward a financing plan with the appropriate analysis of the risk and benefits. And then before anything can happen in terms of issuing pension obligation bonds, the council would need to approve an offering document. And we assume that there'd be a whole lot of interim conversations and potentially an agreed upon memorandum, maybe of understanding of how we're all going to operate moving forward. And then at the earliest, again, assuming a favorable judgment, we wouldn't be into the market until the spring or summer of next year. So, so as an ongoing conversation, as we mentioned in the beginning, this isn't the last conversation, it's just the first. We really do, having gone through the stakeholders group and looking back over the last 10 or 20 years, see POBs as really the final option we have to get to a better funding status. Obviously, we've had lots of conversation today about a need for mutual understandings. And I think over the last, I think we had a joint study session back in October of last year where we started to talk about some of these things. And so I think over the last year, we have gotten better aligned in terms of understanding our shared policy goals and objectives. So as I mentioned, if we are going to issue POBs, it wouldn't be any sooner than next summer, assuming, again, a favorable judgment. So and then do want to emphasize that, as you saw today, the funding status of the both plans are very different. And so the decision-making process for the council will be based on the funding status of the individual plans, and we'll be looking at those policies in that perspective as well. So with that, we're concluded, and we look forward to continuing our engagement and dialogue.
Thank you, Julia, and thank you to all the presenters and all the participants. Lots of good information and data and questions. And as Julia said, this is going to be an ongoing dialogue, and there's a lot more steps that we have to take before we do anything. And this is a good step in the process. So thank you everyone for participating, and this meeting is adjourned.